Be Wealthy and Smart, episode 1052.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about why half of homebuyers are delaying purchases. This comes to us from a recent survey of 900 realtors by real estate tech startup HomeLight. And it said about half of buyers are pressing pause on their plans to buy a home, choosing to wait for 6 to 12 months before restarting the process. And we're also seeing that in mortgage loan application volume, which fell to its lowest level in 22 years, according to the Mortgage Bankers Association. But the good news is it's possible that this large increase could be somewhat of an overcorrection on the part of lenders, and as a result, it may fall somewhere over the coming weeks as lenders better adjust to the current high inflation environment, said Jacob Channel, senior economist at LendingTree. He says rising rates aren't all bad news. Less demand for housing could help to alleviate some of the housing supply crunches that are being felt across the country. Though it's unlikely that home prices will majorly slump, an increase in housing supply will likely significantly slow home price growth and give would-be buyers more housing options to choose from. Of course, the markets are reacting to the Fed's interest rate raise of 75 basis points or 0.75% last week. And there's also their projection of another 0.5% to 0.75% in July. And we're already starting to see the slowdown showing up in the real estate brokerage industry, Redfin CEO says, and he asked 8% of his company's staff to leave. With May demand 17% below expectations, we don't have enough work for our agents and support staff, he said. So they have had to downsize their staff as mortgage rates increased faster than at any point in history. We could be facing years, not months, of fewer home sales, and Redfin still plans to thrive. The increases in interest rates by the U.S. Federal Reserve are the biggest increase since 1994, as it's trying to tame inflation, which has reached a 40-year high. Mortgage rates started at 3% at the beginning of the year and have risen to 6%, which effectively rules out 18 million households from qualifying for a $400,000 mortgage. On a $400,000 loan, a 30-year fixed-rate mortgage at 3% interest rate would cost homebuyers approximately $1,686 a month, excluding taxes and other fees. That equates to $607,110 in total, with $207,110 in interest. Compare that to the current environment. At 6%, that same mortgage would cost approximately $2,398 a month, not $1,686 a month, and would total $863,353 in total, with $463,353 in interest, a 42% increase in overall monthly repayments on the lower rate. Rates going up by 0.55% in 1 week was the biggest one-week increase since 1987. The cost of borrowing is becoming more expensive, particularly for those with variable rate products, according to Mark Hamrick, senior economic analyst at Bankrate.com. The rise in mortgage rates in recent weeks was likely baked into the expected 0.75% interest rate hike, but they say interest rates remain on an upward trajectory. The 30-year fixed-rate mortgage surged past 6% in the last week, its highest level since November of 2008, when the economy was crawling out of the financial crisis. The May inflation report provided the final shove, according to Holden Lewis at NerdWallet. And he said, rates won't have reason to fall with inflation at these levels. Mortgage rates tend to go up and down in anticipation of Fed rate moves, adding that he doesn't expect another dramatic spike in the weeks ahead. So that tells us that the housing market is cooling some, although I don't expect a crash. There's just not enough inventory out there. But what is there is going to sit on the market maybe a little bit longer, or maybe it will still get multiple offers, just fewer offers than they were getting before. But the perception is changing about the market, and people who have been waiting, thinking that by keeping their property off the market longer they'd get a higher price, are now going to reconsider and think about listing their property now because the buyers are drying up. This will help move more to equilibrium where we have more listings, more homes for sale, rather than this being a complete seller's market with so few homes for sale. I think it's quite possible that the Fed's gotten a bit ahead of itself, but we'll have to wait and see in some of the next inflation reports. If they come in higher than where we've been, then rates are going to have to continue upward. But if further reports come in showing that inflation is even or less than where it was, then we can expect to see interest rates back off a little bit, and maybe even see the Fed pausing their interest rate increases later in the year. All in all, it's a good time to sell, much better than it is a time to buy. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.